Welcome to REI Accounting Talk, the show that turns those intimidating spreadsheets into your secret weapon for real estate success. I'm your host, Sarah Bratcher, and I'm here to help you master the numbers game without losing your mind. Whether you're managing your first rental property or expanding your real estate empire, we're breaking down accounting concepts into bite-sized, actionable tips that you can implement today. Welcome back. Thank you for joining me for another episode of REI Accounting Talk. I have been doing this for a few months now, trying to get consistent with it. And in full transparency, I have learned a ton. I usually try to script out these episodes to make sure I don't ramble on a tangent and go off somewhere that I didn't intend to, and I don't forget key points and everything. So I like having that structure, but I'm going to do this one differently. I've got some notes here to kind of keep track, but I'm just going to chat with you like we were having coffee or something. So anything piques your interest, leave it in the comments, send me a message on Instagram, whatever you like. I want to have more conversational type stuff. So today I want to talk about the most common mistakes I see real estate investors making when it comes to their accounting, whether it be bookkeeping. There's some tax stuff in here. Again, I am a CPA. I do not do taxes. I haven't done them in 20 years. I did them briefly for a public accounting firm, and it was not enjoyable for me. And then I went into what we call, I went into industry. I worked my way up there. I ended up being a CFO for a very large company, and then I started my bookkeeping business because I really like this career of helping multiple business owners get to where they want to go and help them read their financials and all that. It's been a lot of growing with this company. I figured so many things out, and I just wanted to share some of the things I've helped my clients figure out. I try to fix everything for people, but it's usually better when we start as soon as we can doing things right. So here's some things. Hope you're doing them right. If not, holler at me. We'll get you hooked up. So probably the number one, and maybe I'm doing this backward. Maybe I should leave the cliffhanger for this one for last, but this is how I wrote it out. So this is how I'm going to talk about it. The most one I see is mixing the personal and business finances, commingling of funds, what have you call it. It makes it difficult to track the true deductible expenses. Oftentimes, more things get put into owner's distribution when there's a lot of commingling of funds. And I know you want those rewards points and all that. And I think that's great. But if it's just best if we can, on the credit cards and the bank statements, to have those separately, it's so much smoother in the preparation. If you were to ever get audited by anybody, the IRS, the insurance company, all of the above, it's just much easier when you don't have those personal transactions mixed in. It helps with your financial clarity of your business. Like when you're looking at your financial statements and you're trying to figure out, decisions to make, where you want to go, is this project doing well? If there's a lot of the small leaks sink ships, if there's a lot of little bitty, oh, I'm just going to throw this on there because it wasn't very much and, it's fine. But it does sink ship and it'll skew your financials, and your property may not be performing as well because of that. You may make wrong decisions on it. But yeah, those are, some common little things that comes up. It costs more when you hire a bookkeeper. And also, if you don't hire a bookkeeper and you just hand in your bank statements to your tax preparer, they have to sort through that as well. So it costs them more time. And in essence, your tax bill is up when that is there. So just some things to think about on that. If you've just purchased your first property and you don't have that LLC to open a business account, just open a separate personal account. Just have the transactions separated. It just makes life so much easier. And number two, the second one that I have written down here is not setting up a proper chart of accounts. This is huge. And I think it's the biggest factor in procrastination when you're trying to do your books on your own. You just get down there and you look at these transactions and you're a deer in the headlines. Where do I put this? And because you have so many options, there's so many ways you could do it. And, just keep it simple, shorten it down. You don't have to put water bill, electric bill, you can put it all in utilities. If you're unsure what's a repair and what's a maintenance item, just do repairs and maintenance so you don't have to make those decisions. Making less decisions for yourself by making a smaller chart of accounts gets this done so much quicker. And if you were to look at your chart of accounts, like on your tax return where your tax preparer use, it's usually even shorter than, a small sample. And talk with your tax preparer to make sure, certain things don't need to be separated out, like health insurance. You need that separated out because it's handled differently on, different entities and how all that is. So talk to your tax preparer on what absolutely needs to be separated out, and then just bunch a lot of that up as much as you can to prevent that analysis paralysis and that mindset of I can't do this because I don't know where it goes. Just start throwing it in there, and then also do an ask accountant or uncategorized or a miscellaneous. Do some kind of extra category in there to just throw it in so you can get it done quickly and you get that win of getting everything in there. And then you can go back and look at the hard transactions and look at those maybe once a day and then try to figure those out and drill those down and, find out that, $1,200 Lowe's ticket, I can't even remember what house that went to and everything. When you sit down to do your bookkeeping at the end of the year, you know, it helps. You can separate it like that. Do the easy ones, throw the rest in a miscellaneous chart of account, and then come back and tackle those one at a time when you have the mental capacity to think about those things. Do it in small chunks. What's the saying? How do you eat an elephant one bite at a time? And that's the same thing with bookkeeping. So get the easy stuff done and then start chipping away at the bigger stuff. The next thing I want to talk about, it's the third on my list, failing to track mileage and travel expenses. Driving to your properties and checking on them, or flying if you have out of area properties and everything, those all can be deductible expenses. And I see people paying for them with personal, and then we get to talking about it, and I'm like, no, 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 you can put that on there. So we have to add it back in because these people have sometimes do separate their business, fortunately, business and personal expenses, and then we have to go back and put them in there. Of course, talk to your tax preparer. There's so many good strategies to get business expenses in there. They have the sandwich theory where you have business on Friday and business on Monday. Then the weekend stuff can be deductible as well. But as always, talk to your tax preparer to see what they're comfortable with and what their understanding of those laws are. But yeah, your travel expenses. We love, as real estate investors, we love the conference. We know those are deductible and everything. So make sure you track all that and get those deductions on there. And also, if you have a lot of properties local to you, use a mileage tracker. And you don't have to use a fancy one. Just use a Google Sheet app on your phone and just, drove by 123 Main Street and 456 XYZ Street today, because you can look and get the mileage on that later, or put your starting mileage and your ending mileage. But yeah, not recording that means you can miss out on some tax savings. And again, there are so many different ways tax wise to handle mileage and vehicle expenses. So talk to your tax preparer to make sure you are on the right track with that. But also don't forget to track it just in case it's on there. All right. The fourth thing I want to talk about, and it's a little confusing when we talk about repairs and capital improvements. And I want to try to approach this in an easy to understand way that's not overwhelming, because there's a lot of information that can get into it. And you can look at the rules and everything. But typically, a capital improvement is anything over $2,500. Again, talk to your personal tax preparer to make sure those are the limits you need to be adhering to. So, if it's under $2,500, it would be classified as a repair. That threshold, whatever that threshold is that you and your tax preparer decide, and of course, using the IRS standards as well. But the repairs are deductible in the year that they are incurred. Capital improvements must be depreciated over the life of the improvement. Cost segregations are a big deal right now. So I think we all know in watching all these cost segregation stuff, capital improvements have different lifespans. Some are 5 years, some are 7 years, um, some are all different. So the theory is you don't get that full expense in that year. You have to depreciate over the year, but then you have bonus depreciation, all these other things, and that always changes too. So we never know what that's going to be. So it's best to put those capital improvements in one bucket. Now, another thing, if you are doing a bathroom remodel, you may not have one single expense in there that's over $2,500. Everything may be under, $2,000. Like it's a small bathroom, you get a vanity for, $1,000. You get a new tub, that's a separate expense. You're buying all these things individually, and there's not one expense that's over $2,500. Any big project like that is lumped into a capital improvement as well. So you can take advantage of that. But if you were just painting your bathroom, then it's probably less than $2,500 and that can be deducted. So again, it can get confusing. There's so many rules about it. Just be aware that they are two different transactions, a repair and a capital improvement, and make sure your books reflect what your tax preparer needs to see to do it appropriately at tax time. Of course, your bigger repairs, like an HVAC system, most of those repairs or replacements is going to be over $2,500. So that one item must be capitalized. So that can lead to underpaid, overpaid taxes, which goes into, if you were to get audited, the goal is to not get audited. Hopefully, we never get audited. But I'm telling you what, if you ever do, you want to do this due diligence. It's a headache, if not. But absolutely, again, contact your tax preparer to make sure it's in line with your tax strategy and what all you have going on. The fifth one is a big one, and people can kind of take this personally. They get a little protective over this, and it's understandable. It's a big task to reconcile your bank and credit accounts on a monthly basis, on a regular basis. And I think in our mind, we think, oh, we've just had a couple of transactions. It's not going to be that hard. And then it piles up and it piles up and piles up. And it's just this mountain of a task. And if we do them on a regular basis, monthly, and there's less time between the transaction when we have to record it, so we're more likely to remember what it's for, and we don't have to dig for everything at the end of the year, which is fine too. I do cleanups all the time. If you need help cleaning up, just holler at me. We're getting good at it. But the monthly reconciliations ensure that all transactions are recorded and you're not missing out on anything. So at the end of the year, it's easier to just, make that go quickly. Because if you miss a transaction or if you have a duplicate transaction, it'll throw off your profit and loss and it's harder. I mean, you can't make accurate decisions and your taxes will be off. You may be overpaying or underpaying taxes, all that. Also, a big one is bank errors. If you don't look at your bank statement at least once a month, like bank errors, you need to bring to the bank's attention rather quickly. Like some banks are 30 days and you don't get to, you know, file a claim on fraud or anything. It's just you eat the loss. So looking at those, on a regular basis will save you money there in case something like that would happen. There are accounting software that makes reconciliation easier. I don't want to go into the nitty gritty about it, but there's two types of accounting systems. There's a double entry system and a single entry system. And if you've ever heard of the term of balanced books, It's because it's a double entry system and all this entries balance. It doesn't mean there are never errors. It means there are less room for errors, especially in the bank reconciliation. So, if you have an accounting software that does not have a reconciliation feature, you probably have a single entry system. And just beware that there's a lot more room for errors. So, as you grow, I would definitely find a double entry system like QuickBooks to do all that. And of course, delayed reconciliations create stress at tax time. Most of these things funnel into more stress at tax time. So, addressing these things throughout the year usually equals less stress at tax time. And another one that I see, and this is more in the tax lane, but I do want to address it. It kind of goes back to the capital improvements, but it's overlooking depreciation and cost segregations. The political times, tax depreciation allowances are up and down, up and down. It's a roller coaster. So the best thing is just to keep everything up to date as it comes, because you never know when you get 100% depreciation back, or you never know when, you know, the depreciation is going to be there. So find a good tax preparer that will think about cost segregation. Cost segregation is not great for everyone. Make sure you talk to your tax preparer and figure out if it is right for your strategy. If you have no plans to sell your property for many, many years, cost segregation might work. But if you have plans to sell it when the next year or two, you might not want to do it. Talks to your tax preparer about it, but be aware of it. And you can also, on the capital improvement front, use it to time when you do depreciation. If you don't need a loss this year and it's in December, then maybe wait till January to do those improvements. You can always kind of manipulate when it goes along and everything. But again, as with all these tax things, talk to your personal tax preparer that knows your personal information, all of it, everything, because it affects all of it. And then piggyback onto that, this is my seventh item here. It goes along with it, but ignoring passive loss limitations. You may not need that cost segregation and all that depreciation if you are going to be capped at the minimum passive loss limitation. There's lots of tax strategies out there. I'm a real estate investor myself, and I'm trying to utilize some of them, but everybody's tax situation is different and they can get so complicated when you get into your own details. So again, I hate to sound like a broken record. Consult your tax strategist for more details and also be aware of it. There are lots of videos out there that go deep dive into it, all the ifs and or buts on cost segregation and passive loss limitations. That could be easily an hour long conversation going over every single thing that's in there. And it is completely dependent on your personal tax situation. And number 8 is not keeping your proper records for the expenses you are claiming. The IRS does require receipts and documentation for all deductions, not when you file your taxes, but when you get audited. And the chances of getting audited, we don't know how to accurately predict that. But if you were, I promise it's much easier if you have all that documentation. And you have other audits that can happen too, like your general liability audit, and you need those invoices in to prove that they were a contract labor and they weren't an actual employee. And you need to keep all of that documentation. The biggest way people are doing it these days is digital storage. You can use like QuickBooks, you can attach your receipts and your invoices to the transaction in there, but there's not a good way to get those out in bulk. So it's good for if you have a team of people and you're looking at your financial reports on the computer and everybody's like, oh, this, why is this? And you click into it and you're like, "Oh, yeah, it was that receipt," and you have that record right there. That's what it is good for, attaching them in QuickBooks. But if you need an audit or some other situation comes up, or if another program comes out that's even much better than QuickBooks and you want to transfer to it, then you have to go in and download those one at a time. And that's going to take a lot of time to do. So I would do it two ways. I would find a free drive to put it on, especially one on your phone. So you can take a picture of it at the checkout counter. Use a naming convention, the date, the address of the property, and, plumbing or whatever category it goes in. Use those naming conventions, get it done right at checkout, and throw it away. Or keep it if, you don't trust the digital stuff. Or keep them all in a box. Just keep them. Keep your receipts. Don't throw them away. You never know when they come in handy, but when you get the random out of left field, like, "Hey, we need to verify this," it is so much better when you had it. I have gone through many, many receipts in my lifetime, keeping everything up for people, and it is so much easier when I have a box of receipts, even though it's not organized, than when I have no receipts at all. And I have to tell these people, "Hey, look, you can't prove these expenses, so you're on the hook for all this interest and penalties along with the liability." So, along with that, on your meals and travel expenses, if you had available, I would actually write on the receipt some more information. The date, the amount is on there, but I would write, for the meal especially, who the meal was with and what you discussed, and any other important information about that meal, um, to prove to the IRS that it was a legitimate business expense and you weren't just taking your spouse out on a date. Poor record keeping will lead for the IRS to disallow deductions if you were ever audited. Another one more that I just thought of, your home office deductions for like your utilities and stuff like that. Again, you consult your tax preparer on which strategy you want to use for the home office deduction, but you need to keep all those as well. I think that's a big one. All right, number 9 is paying contractors without the appropriate 1099 compliance reporting on there. So the IRS requires for you to submit a 1099 for contractors doing a service to you if they're paid $600 or more. There's kind of other situations gone around that. The first thing you need to do is, before you write a check for someone for doing a service, is collect a W-9 form up front. And I would actually do a W-9 form and require them to submit a general liability certificate. Because if you're doing a lot of flipping or if you're doing a lot of rehabs and you have general liability on your own company, you will probably eventually be faced with a general liability audit at some time. So I would get those two things, get you a paid Adobe account or something so you can send them digitally to be signed and all that, making it less work for them to have to print it out and sign it or any of that. Do what you can to get those W-9 forms signed before the check goes out, because after the check goes out, you have no control unless you have them, on forever and ever. And you're like, okay, you're not getting another check until that. Because let me tell you, when it comes January and you're trying to get 1099s out, it is much easier to just go through and submit them instead of having to then collect all the stuff you need. So you collect the W-9 and that tells you like how they fill it out, will tell you whether or not they actually need one. There's rules around S corps don't get a 1099, but if it's a lawyer and it's an S corp, they do get a 1099. So there's lots of rules out there. Make sure you know it. My property managers, if you are collecting rent and you are writing a check to an owner, you have to give the owner a 1099 as well for that money that you give them. So you are not taxed on that income from the actual tenant. And that 1099 needs to be what the tenant paid up top, the gross rent, not what you've paid them after all the fees. That's clear. Let me know if you need more information on that. I know 1099s are another ones that have rules. There's a lot about issuing 1099s for people that have used a third party payment processor. And you just need to know, if you use a third party to pay somebody, most likely you don't have to give a 1099 if you use Venmo, if you use Zelle, Cash App, a credit card. You don't have to do a 1099. It is on the credit card, Venmo, and those other places to issue a 1099 to that contractor. And they have completely different reporting amounts. It's not $600, but it's not on you, so you don't have to worry about their thresholds. It's changing, it's up and down. They're on their way to be $600 as well in the next few years, but you don't have to worry about that. Don't give them another one, because then they'll get duplicates from, other places. And if they don't actually get a duplicate, then they've not hit threshold. And anyways, it is what it is. If you pay a third party, don't worry about a 1099. If you pay through a third party, sorry about that. So track that early and often. Get those W-9s and find a way to get those W-9s signed before you get that first check out to them. I promise it's so much easier. And number 10, I'm kind of partial to QuickBooks because I've used it for so many years. And it's just the best way to report for real estate investors. The class system, the amount of reports you can pull from there, it's my preferred method. I guess I never really said. So, not using a good accounting system. When you are, in the beginning, an Excel spreadsheet works just fine. But as you grow, it's going to become so overwhelming, and you're going to spend more time on your Excel spreadsheet than you can growing your business. So, it's just, honestly, it's not cost effective. Um, but with something like QuickBooks, you can automate your transactions. You don't have as much to enter. There's less room for error in automation. Spreadsheets can easily, have errors in them because you don't have the double entry. You don't have the balancing system in there, and things can get off so easily. As with, single entry accounting systems like Stessa. The reporting in QuickBooks, I started talking about that earlier. The reporting in QuickBooks is just, it's great because you can pin it down to, a single project and look exactly, which of your projects are profiting you and which are, draining your funds and resources. And you can just make so much better decisions with stuff like that. And, you can connect your bank accounts and you can have real time financial data in there, and just keep it up like that. So that's a big one. I know QuickBooks can be overwhelming for someone who's not an accounting mind. And if you're thinking about QuickBooks and you're like, I don't know how to do it and everything, QuickBooks is basically just a glorified spreadsheet. It's built on, a spreadsheet software. And if you go back in QuickBooks and look, you tab over to go to each different ones. There's just lots of gray spaces in between those spaces. And oh, a quick tip, I get a lot of people on this one. If you're entering an amount in QuickBooks, and you can do a formula like you can on a spreadsheet. So if you need to split something, a transaction, and $500 went to unit A, you can do the amount, minus $500, and that goes to unit B, and $500 goes to unit A. But yeah, you can enter that. It's hard to explain without it here in front of me, but anyways, just try it. Do plus or minus at the end of the number, and it's a fun little trick in QuickBooks that I don't think a lot of people know about. But you can subtract and add your numbers. You can even divide, multiply if you need any of that in there. Anyways, just a hot tip. I am working on a bookkeeping course, I guess you'd call it, program for do it yourself real estate investors that want bookkeeping. And I'll be talking about a lot of this stuff in that course as well. But I really want to help real estate investors, take the overwhelm out of the accounting for their company. It's unfamiliar for a lot of people, and it's intimidating for a lot of people. And I want to try to use, standard talk, and I don't want to use fancy terms. They come out sometimes because I don't stop myself, but I'm really trying, and I really want for everybody to kind of understand where their books are. Even if you're not doing your books yourself and you have hired a bookkeeping company like mine, I think it's great for you to know how it actually works. So you can kind of see the big picture on things, and you can see why things were coded this way, and you can see why it's on the balance sheet or the profit and loss. And, you just have that little edge of, knowing why your financials are the way they are and you make decisions. I am a huge believer in using your financial statements to make big decisions for your business because it all comes down to numbers. Because if it's not bringing in the money, then it's probably not good unless you need a ton of losses. Then you don't care. But that is what it is. So anyways, those are the biggest things I see people making mistakes on when it comes to their accounting. If you need support, if you need help, follow me on Instagram and watch for the big announcement for my course that's going to be coming out. Along with the course, I am going to be offering a monthly subscription for an office hours co-working type, and it's for other real estate investors. I want to build a community for them to be able to hold each other accountable to get their bookkeeping done. Not really like a mastermind, but like, hey, I'm going to get January done by this Friday, and I need you to ask me about it and make sure I get it done. Hold them accountable so you're not getting it all done the day before your taxes need to be filed. So it'll be a kind of a co-working, but also you'll be able to ask me or one of my team members questions about what's going on. And I'm also going to offer one-on-one for people who have taken the course. I will offer one-on-one sessions where we log into your books and we can figure out what's wrong with that journal entry, or why is this not looking right? Why is this over here? Why can I not get this reconciled? So I'm going to be offering kind of, one-on-one help and group help and all that along with the course. I feel like it's really needed in this community. Real estate investors want to do their own bookkeeping up to a certain point. It is kind of an expensive, outsource for you to make. And it's hard to do it because it feels like it should be easy, and it can be, but it uses a different part of your brain. So it's also, pretty overwhelming when you just get started. So I just want it to be a safe space for everybody to go in and, be like, hey, I don't know how to do a journal entry. And nobody knows how to do a journal entry. So we learn how to do it together and kind of that. But there will be a course that introduces QuickBooks and does, the basics to it and everything. And I would encourage anyone who wants to do their own bookkeeping, or if you just want to know more about what it's doing, it is QuickBooks focused. If there's ever another platform out there that I feel is good for real estate investors, then I would do another one and start moving to that and everything. But for now, it is QuickBooks focused, and I think there's going to be a lot of QuickBooks stuff in there, but there are a lot of things that you can use if you use your property management part in accounting, because I will talk about a lot of the chart of accounts, like how to make that simplified, and go over my chart of accounts that I use for everyone, and getting all that done. So, I mean, there's lots of things in there that's not specific to QuickBooks, and you can get around it as well. But I have experience with other property management softwares, accounting systems, so I can answer some of those. Appfolio is a big one I've used for years. Buildium, I've got some clients on it as well. So I know my way around it. My humble opinion on those is they are in the business of providing property management software, and they do amazing with that part of it. Getting the leases out and the maintenance request and the tenants request and all that. They do amazing on that, but their accounting pieces seem to be overcomplicated in it. So it's not always the smoothest, but it can work too. So Anyways, thanks for tuning in with me today. I appreciate you listening to me ramble on about this. And I would love to help you out. If you ever need anything, just give me a call or find me on Instagram, rei.solutions.with.sarah. And I think if you're watching me on YouTube, subscribe. Or if you're listening to me on a podcast, subscribe, like, download, all that stuff. Like I said, I'm still new to this podcast thing. I'm learning it. Thank you all for learning with me. And we'll get there. I just want to help y'all out. All right, y'all. Take it easy and stay tuned for that course coming out. I'm really excited about it. Thanks for joining me on another episode of REI Accounting Talk. Don't forget to check out our show notes for additional resources and templates mentioned in today's episode. Have a specific accounting challenge you'd like for me to address? Reach out through our website or social media channels. You can find me on Instagram at rei.solutions.with.sarah. Together, we're building a community of confident, financially savvy real estate investors. See you next week.